Imagine waking up in 2026 and realizing a single mistake cost you a year of income. In this video, I'll walk you through 10 financial mistakes you must avoid in 2026. Simple, practical, and often overlooked. Pay special attention to numbers 9 and 10. They look harmless, but are the most dangerous. By the end, you'll have concrete tactics you can apply tomorrow to reduce risk and protect your money. Stay with me. The last two items could save you thousands. Thinking that a government guarantee or a big platform seal means no risk is the oldest trap. In 2025, many retail investors assumed platform-backed tokens or government-endorsed schemes were safe, and some lost money when liquidity evaporated. Example: people treating promoted projects as bulletproof because a famous institution mentioned them. Tactic: always ask, what is the cash flow? And who bears the loss if things go wrong? If you can't answer clearly, don't commit large capital. Rule of thumb: trust the economics, not the badge. Trying to time the market every week leads to emotional trades and fees that eat returns. In 2025, many people jumped into day trading during volatility spikes. Small wins looked addictive, but fees and losses mounted. Example: frequent buy-sell cycles eroding gains after commissions, taxes, and slippage. Tactic: if you can't commit to a plan, use low-cost index exposure or set strict daily loss limits. Treat short-term moves as noise, not income. A simple rule: if you don't have a strategy for losses, don't trade. Low interest rates tempt people to borrow to invest, but leverage multiplies losses. 2025 saw cheap consumer credit offers and buy now pay later schemes being used to buy risk assets, a recipe for disaster if markets wobble. Example: using margin or consumer loans to buy speculative assets. Minor drawdowns can trigger margin calls and force selling. Tactic: keep leverage minimal and only use debt for productive assets, education, reliable real estate cash flow, not for speculative bets. If you borrow to invest, stress test the investment with a 30 to 40% downturn. Keeping cash under the mattress is still a hidden loss. Inflation erodes real wealth. 2025 inflation spikes pushed people's savings to lose purchasing power. Some short-term bond funds couldn't keep pace. Example: thinking a high-yield savings account is enough, while real returns are negative after inflation and taxes. Tactic: hold a mix, short-term inflation-linked assets, diversified equities, and emergency cash. Rebalance yearly. Tip: aim for real return after inflation targets, not nominal rates. Spotlight investments, meme stocks, new coins, trendy startups attract attention, not necessarily fundamentals. In 2025, meme AI token frenzies showed how narrative can detach price from value. Ordinary folks bought at peaks. Example: FOMO-driven purchases because everyone on Reddit said so. Tactic: require a clear thesis. How does the asset produce cash? If the thesis is, they'll sell it for more, that's speculation, not investing. Practical move: limit exposure to speculative bets to a small percentage of your net worth, e.g., less than 2 to 5%. Having everything in long-term bets leaves you exposed to near-term shocks. 2025 showed us layoffs and supply shocks. People who had no 3 to 6 month buffer had to sell investments at bad times. Example: someone invested all savings in a high-return fund, then lost job and sold at a drawdown. Tactic: keep a 3 to 6 month emergency fund in ultra-liquid accounts. Separate investment and liquidity buckets. Small rule: never tap your long-term growth bucket for short-term needs. Small fees compound. Platform spreads, currency conversion, and management fees quietly eat returns. 2025 traders learned the hard way. High-frequency moves plus fees plus taxes equals negative net outcome. Example: an investor thinking 5% gross is great, but after fees and tax, it's 1 to 2%. Tactic: compute net expected return after all costs. Choose low-fee platforms, prefer tax-efficient accounts, and fund wrappers. Practical behavior: check TER/expense ratio, trade friction, and tax treatment before entering. Putting too much into one sector, one coin, or one property is common and risky. 2025 concentration in a single thematic ETF or a single hot stock wiped out investor portfolios when that theme corrected. Example: housing-only investors in a local bubble or tech-only portfolios when rates rose. Tactic: diversify across asset classes and geographies. Use simple core satellite approach. Core diversified index plus small satellites for bets. A practical target: no single holding greater than 5 to 10% of investable assets unless you truly understand the downside. This one is sneaky. You can do everything right on paper, but if your custody is hacked or platform freezes withdrawals, you lose access. 2025 brought more exchange hacks, frozen withdrawals, and rug pulls. People lost assets even when markets were up. Example: credible centralized exchange halts withdrawals during a crisis, leaving users locked out while prices crash. Tactic: spread custody. Use regulated custodians for large sums, hardware wallets for crypto, enable two-factor authentication, and keep clear withdrawal contingency plans. Remember, liquidity and access matter as much as asset selection. This is the root cause: unchecked emotions. FOMO, panic selling, and herd behavior destroy returns. In 2025, we saw sharp buy-then-sell cycles driven by social platforms. People chased trending plays and sold at bottoms. Example: buying a token at the top after hype, then panic selling 50% down. Or selling a diversified core position after a bad headline. Tactic: implement rules, automated rebalancing, predefined stop-loss for speculative positions, not for core, and a written investment policy statement you follow. Behavioral trick: wait 24 hours before reacting to viral noise. Most hot tips evaporate. So those are the 10 mistakes. From trusting badges to letting emotions run the show. If you act on just 2 things today: 1. Secure custody and liquidity, item 9, and 2. Install behavioral rules to avoid FOMO, item 10, you'll already be far safer heading into 2026. Comment below which of these surprised you most and which tactic you'll try first. If you want a downloadable checklist for these 10 items, hit subscribe and comment checklist. I'll pin a link. Thanks for watching. Protect your capital, think long, and don't let the hype win.